This is the third in a series of videos about payroll, looking specifically at software and real-time information. So to begin, software functions. So recording employee details, calculating pay and deductions, reporting payroll information to HMRC, and calculating PAYE and national insurance contribution liabilities, as well as any statutory pay, which might include statutory maternity pay, SMP, or statutory sick pay, SSP. So businesses have to use computerized payroll software because they have to be able to report in real time, which we'll come to in a second. They can run their own payroll or they can outsource it, but it has to be a computerized system. The beauty of that, of course, is that the software will be updated regularly for any changes in tax legislation. So, any changes in the rate of PAYE or national insurance thresholds, the software will be able to deal with all of that for the employer. Employers must run payrolls using computerized software, which can then transmit real-time information, RTI, to HMRC. So this can be done by using commercial payroll software. So for example, you might have heard of Sage. They make a payroll software package. You can just buy that and use it. And there's many others available as well. You can use HMRC's basic PAYE tools software, which apparently is free of charge. So if you only have up to 9 employees, that's up to and including 9, so less than 10, then you are able to use this tool of theirs for free, and that will comply with the real-time information requirements. Or, of course, you could outsource to a payroll provider, which might just work out cheaper in the long run. A payroll provider will have the required software, they will have the expertise, and things should then run very smoothly. Notably, the government sets the tax rates for each tax year in the Finance Act, so you're aware that this exam is the Finance Act 2021 at the time of recording. And as I've said previously, the tax year runs from the 6th of April one year through to the 5th of April the next. So a business is required to make sure it's using the correct version of software, that it applies to the correct year. And as we saw on those pay slips in the earlier video, each month relates to like a tax month. So month 1 would be the 6th of April to the 5th of May. Month 2 would be the 6th of May to the 5th of June. And again, it's necessary that the business makes sure it's using the correct month when it's running its payroll. So all of that is just, all that stress is just taken away if you do decide to use an external payroll provider. So what's all this about real-time information? Real-time information reporting. Right, there are 2 main submissions that generally will be made. The first one is the full payment submission, frequently abbreviated to FPS. So this is what happens whenever someone is paid. Payroll information must be reported to HMRC on or before the day they are paid. So this information is sent about the amounts paid to all employees, their deductions, and details of any joiners or leavers since the previous full payment submission. We then have what's called an EPS, the Employer Payment Summary. So basically, you would have submitted your FPS at the time of payment. And then on the 12th of the following tax month, so remember each tax month starts on the 6th of the month. So on the 12th of the next tax month, the employer can see how much they have to pay over to HMRC. By the 19th of that same month, they can, the employer this is, submit an EPS, an employer payment summary, which will make claims for any SMP, statutory maternity pay, any employment allowance, so that is the £4,000 that's available for an employer to offset against their employer national insurance contribution. It was discussed in an earlier video. Any CIS deductions, so that's the construction industry scheme, or to pay an apprenticeship levy. So that's something that's paid by large employers. They pay into a pot and then they can use the money from that pot to train people using apprenticeships. So note the dates. So you've got that FPS has already gone in at the date of the payment. The 12th of the next tax month, they can see how much is due. By the 19th, they can submit making additional claims that will reduce their bill in effect. Another use of the EPS is if there is no FPS required because no one was paid during a tax month, then an EPS will just be submitted basically to confirm that. So again, let's just remind ourselves that we will have available reference material in the exam. So the full payment submission, we're told here, we file that on or before the employee's payday, and it includes payments to and deductions for all employees. And then there is a note about the EPS, the employer payment summary, where we file it if no employees were paid in the month, and we send it by the 19th of the following tax month. But remember, it can also be used, and it doesn't tell us this in the reference material, it can also be used to claim those deductions for the employer allowance, the SMP, etc. So what happens if you don't do this on time? Well, you get a penalty. So a couple of penalties I want to discuss alongside what we've been talking about here, which is for late submission or inaccuracies in the submission. So let's have a look at each of those in turn. So penalties for late submission of payroll filings. The easiest thing to do here is look at the AAT reference material. So penalties may apply if the FPS was late, the expected amount of FPS was not filed, or an EPS was not filed. And the penalty depends on how many employees the business has, as you can see here. There are a few times the penalty may not apply. I've highlighted those at the bottom. So if the FPS is late, but all reported payments are within 3 days of the employee's payday. If you've got a new employer is late, but sends the first FPS within 30 days of paying the employee. So you get a bit of a let up if you're new, or it is a business's first failure in the tax year. So then you get a little bit of a, right, okay, don't do it again. So here's a quick example of using that information. So if we have a business that employs 15 people, their tax liability is £4,000 per month, and the FPS has been submitted late 6 times in the tax year. The first 5 times it was late, it was within 14 days, but the last time it was a whopping 8 months late. Right, so let's have a think about just looking back at this for a minute. So we've got 15 employees, so we're looking at £200 per month. And then don't forget the first failure is kind of allowed. So How late it is actually irrelevant here. We will just have no penalty for the first month and then £200 per month for the other 5 months, so £1,000 penalty for the late submission. Note as well that if the FPS is not submitted at all, then HMRC can raise an assessment and estimate how much they think is due. So you can't just avoid it and hope for the best. The other type of penalties that I mentioned was if there are inaccuracies in the payroll filing. So you have sent it in, but there's something wrong. So here we can see that a penalty can be charged as a percentage of the potential lost revenue. So that basically means how much should you have paid, right, if you had worked it out correctly. And they distinguish between careless, deliberate and concealed. So careless means it was a genuine mistake. Deliberate means you knew about it. Deliberate and concealed means you knew about it and you tried to cover it up. And then it also matters whether it was an unprompted or a prompted disclosure. So unprompted simply means that the employer goes to HMRC and tells them about the problem. Prompted, as you can see, higher percentage penalties means that HMRC were onto you and asking questions. So I guess it follows that if you had to be asked and you'd made a deliberate and concealed error, the penalty can go right up to 100% of the amount that you owed. On the other hand, if they deem it to be careless and you told them about it, you might actually get away with nothing. Right, so you don't have to memorise this, it's all in the reference material.